Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. Today is July 5th. This is host Richard Benuli. Today we have Rafi Farber and Ira Harris. Rafi is a financial journalist, lives in Israel, has been a libertarian ever since the Ron Paul 2012 campaign, and he's the publisher of The Endgame Investor. And Ira is independent trader, hedge fund manager, and global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and a stint most recently. Welcome, gentlemen.
Thanks for having me.
Thank you. I'm glad to be here.
Great. I thought we'd begin, Rafi, with your view on the global economy and the financial markets, just in general from a macro perspective.
A macro perspective. Yeah, after this, I actually have a question for Ira. Remind me of that. So I don't really look at all of the markets. I don't pay that much attention to equities, stocks. I watch mostly bonds and commodities because the way I see things right now is that the monetary system has been so deeply disturbed by the 2020 printing insanity across the world that we have such an overhang of extra money in the system. And I generally, before this happened, I would analyze the markets in terms of where money supply growth is at any given time. Now we've been technically in absolute deflation. I'm not talking about consumer prices. I'm talking about money supply. When I say inflation, deflation, I'm talking about the inflation, deflation of the money supply, meaning the dollar supply and other currency supplies. So we've been in deflation for about a year and a half now. And it's the strongest it's ever been. And usually in those conditions, that leads to a crash of asset prices across the board, stocks, bonds, commodities, all of them at the same time. And that hasn't happened this time yet, seemingly because of the overhang of the overhang of the printing from 2020. And now that all that extra money that couldn't make it into the system is now starting to flow into it through the Treasury's account at the Fed, because the Treasury is selling all these bonds, all these Treasuries, and the extra money from the reverse repo facility is starting to flow into the monetary system now. Meaning there's so many wild cards here that it's impossible to even use money supply growth as a gauge for what the hell's going to happen next. So look, we saw that we had a serious regional banking crisis, which is going to happen when you raise interest rates after banks buy, hundreds of billions in bonds. Okay, that's going to happen. You don't have to stress test for it to know it's going to happen. So we're just waiting for the next financial system blow up. Exactly when it's going to happen, I don't know. But once it happens, I think that's going to be it for the dollar, because then you're going to have to go vertical on the inflation, on money printing. I mean, it's too big already. So I'm just waiting for that. And whatever the markets do in the meantime, I'm just, do your thing. I have no idea where you're going. I'm just preparing for the end.
Interesting points. And your thoughts, Ira?
Well, this is a very interesting discussion. I've never talked to Rafi before, but as my jump off point would be, we have, to paraphrase Mao Zedong, we have a lot of piles of tinder that are ready to be lit. Which one where, I have no idea. But this is the most precarious economic situation in a global way that I've seen. And and where Rafi picks up with the money, and I'm looking at everybody else who's watching this or who will watch this, you can see Von Mises behind him. So when we talk about money, we're talking about money and credit from a very reliable perspective. And as Rafi says, can we time this? No. But again, the piles of tinder are very dry and drying. And what adds to that, every morning, the first thing I run are the 2-10 yield curves of 25 countries around the world. And I will tell you today that 21 of them, I believe, are inverted. The only ones not inverted are Greece, Italy, Japan, but Japan is a whole nother situation, which I hope we get into a little bit, because how do you measure it? But the world is fraught. And if you just look at equity markets, okay, you can find a lot of comfort there, but they've defied a lot of people. And, I would argue that a lot of that being able to defy it is, of course, is that the Japanese have kept the pedal to the metal and are still providing a lot of liquidity that wends its way around the global system. And I'm really kind of shocked that the central banks have sat there and allowed this, because everything the Japanese do, it's not a monetary policy decision anymore. This is far greater than that. It's a trade policy, and as Louis Gavay and I have talked about, and I have great respect for Louis, is part of the policy of the G7 in an effort to reshore out of China to allow Japan to rebuild a lot of what have been howled out industries. And they can do it with a highly, David Hay from Gavay, he talks about it too. The yen is the most undervalued currency in the world, in the developed world for sure. So, this all plays into it, and it's a global phenomenon. And I'm glad that Rafi brings it up, because even though globalization is starting to roll back a little bit, global financialization is not rolling back yet. So we're starting to see the effects. So.
Great. And Rafi, do you see similar fire tinder points around the world? I know you've written a lot also on the repo market, the repurchase agreement market. Maybe that's one of them, or your thoughts?
Yeah. There's definitely dry tinder everywhere. It's impossible to know where to start to describe it. The entire situation of the monetary system in the whole world is as insane as it has ever been in human history. None of this makes any sense. All major central banks are now in negative equity. They're all losing money. And what does it mean when a central bank loses money? Well, as issuers of currencies, if central banks lose money, that means that their currencies are on the verge of dying. Everyone wants to think that central banks, their balance sheets don't matter. Well, if their balance sheets don't matter, then you don't need them at all. And then you should stop recording everything and just print punches of paper and just stuff them in different places and stop accounting at all. Why do we even account if it doesn't matter? Of course it matters. So, all of these, because especially Japan, Japan is so stuck. There's nothing they can do besides print money, because that's all they've been doing since 2013, almost straight up. And look at the Bank of Japan's balance sheet. But I wouldn't even say that the Bank of Japan has a policy to achieve any specific thing. They're just trying to stay alive. And if they were to, let's say, push the 10-year, stop their yield curve control on their 10-year bond, it could collapse their entire system. That's how addicted they are to what they've been doing. And it's the same as a drug addict. You can't stop it without significant pain, and at a certain level you can't stop it without delirium tremens or just dying from the reaction. And that's where Japan is. Japan is one of the worst. You could say that the yen is undervalued, but what does that even mean? The yen is just the collection of the other side of the Bank of Japan's balance sheet, which is so stuffed with worthless paper that you can't. How does anyone even value a currency anymore? I don't even know how to do it. They're all so fake.
Mm-hmm. Ira, did you want to elaborate on Japan? Your thoughts?
No. As a trader, which Rafi says, that's not what he's looking at. So he looks at the world and analyzes it and puts out, and he sells, or I believe he's in the business of giving people a glimpse, but from a trading viewpoint, and I'll have to go to it right now. Sorry.
I'm not a trader. I don't really give trading advice that much. Sometimes when I see you, I think, it's a good time for an entry point. I'll say that, but that's not my thing. I'm more of a monetary philosopher trying to get people's heads just wrapped around globally what we should be seeing here and how we should be interpreting all this insanity to make some kind of sense of it.
Yeah. So to make that point, which I think is very important. So everybody talks about fiat currencies, but fiat currencies have run amok, and meaning fiat currencies are dependent upon central banks and governments, fiscal policy and monetary policy to act responsibly. Yes, it can run out, and there are cycles where you will get imbalances, but there has to be a responsibility to it. And to make Rafi's point about the Japanese, and I always watch this because every currency, not just in dollars, but I look at their value to gold. So yen to gold, and we've just made in the last, over the last 4 or 5 weeks, all-time highs of gold to yen. So when people say, oh, gold is, gold to yen, all-time highs. The euro has actually, held up because, again, what are they doing? The euro is, in Europe, they're busy raising interest rates, and the market becomes enamored with interest rates. But the effective real yields, which is really all I care about, are effective real yields. Or, if they're negative, fine. I have a very good understanding of what seems to do when real yields are negative. When real yields turn positive, I have an idea of how the markets over historical periods have reacted to that. So the Japanese yields real yields are so negative, and I don't care what they tell me. Is it 3% inflation, 3.1% inflation? All I know is when you have overnight rates, and I'm talking about overnight rates because right now the central banks are so busy controlling longer term duration, which through their balance sheet operations. But overnight, so real yields in Japan are vastly negative, which is why the yen is as weak as it is. But because the weak yen affects global trade, and the yen is a trade currency at this juncture, just like Chinese yuan is a trade currency. The dollar is a financing currency. It hasn't been a trade currency probably since 1866. No, until the 1920s anyway. And that's the world in which we exist in. But one person, the hilarious, and it's hilarious. The U.S. Treasury comes up with that, the watch list of currency manipulators. And who do they cite as the currency manipulator? The Swiss National Bank. Meanwhile, the Swiss...
This is all nonsense, but they're all currency manipulators. That's what they're all doing. I don't know. What are they pointing fingers at each other?
Right. But the Swiss is at all-time highs versus the Japanese yen. It's at almost all-time highs, except for that 1 or 2 weeks in January of 2015 against the euro. So how is it that the Swiss can be deemed the currency on the watch? The only currency on the watch list is a currency manipulator. The U.S. Treasury is a joke, and the fact that they put that out, really, I think I did better research work as an undergraduate. I mean, it was pathetic. So fiat currencies are dependent upon good policy, and we're not seeing good policy. So,
this might be where my way of looking at the money world is different from most people, even people with an Austrian bent. I don't believe that fiat currencies exist. I don't think it's possible, and I can prove it logically. If you mean by fiat currency, what we have today, obviously they exist. I'm not saying there's no dollars, and I'm saying that there can't be any such thing as a fiat currency because it implies that it has value because it has value, and that's a circular logic. I mean, you have to ask the question, like, what is it that gives a fiat currency value? And we'll say, well, the government's power to tax. That's not possible either. Because if that was possible, then hyperinflation would, if that was the answer, then hyperinflation would never happen. Because it's not like, in a hyperinflationary environment, a government can't tax you in its fiat currency. It can, and it does, and it still becomes worthless. So it must be something else. What is giving a fiat currency its value? And well, so if you go back to Mises over here, he has the regression, the monetary regression theorem, which I call the monetary regression principle. It's not a theorem; it's just a principle that all prices have to go back into the past. Which the only way that prices make any sense today is because there were prices yesterday that you can say, oh, prices were there yesterday, and so they must be here now. And that's how you fit to the division of labor. And you can never ever break that chain. But what can happen is when you go back far enough, right? The dollar was a certain amount of gold, and that's why it has value. So at a certain point, it's not going to have any gold value. And at that point, you're going to have hyperinflation. And so the fiatness of the dollar is the fact that it's not linked to gold directly anymore for a statutory amount, but it is still a gold currency, because once you can no longer trade the dollar for any gold, it cannot buy a single damn thing. It will die. The gold window is the exchange rate between the gold and the dollar. And for every other currency too, it's either a dollar substitute, a dollar derivative, or it's a gold derivative of its own right if the central bank happens to have some gold that they won't sell. But there is no fiat currency. There's just gold and the main substitute for it, which is the dollar, which makes it the world reserve currency because it's the standard gold substitute. And then every other currency that's built off the dollar. So, I mean, because all central banks are pretty much locked into they're following each other, they have to, because their goal is they don't want the exchange rates between their currencies to wobble too much, because that just destroys the trade relationships between a bunch of countries. So they're just locked into this dance. They can't get out of it. There's no such thing as responsible or irresponsible policy. Now they have to just keep going at the same rate they're going. And because of the lockdowns and because of all that stuff that happened, now they're all in a much tighter dance. They can't get out of it. And now they're trying to stop all at the same time. And then they're going to crash it all at the same time. And all the currencies are going to go away at the same time. I mean, that's what's going to happen.
Yeah, very interesting points in perspective. Your thoughts, Ira, on that?
Well, I think it's a very interesting perspective, and where the Austrian school really gets it right. And I found this out in the 70s when I was studying this, and especially monitoring what we called third world debt, less developed country debt, which was just being recycled petrodollars in order to fund the importation of energy to sustain those economies, which led to a huge amount of growth in debt. Who borrowed money? Only the least credit worthy were borrowing those substantial amounts of money, and the Austrians understood that. The Austrians and the Marxists, the neoliberals' view of they didn't know that was good lending, and I know because I talked to enough banks as I was looking for a job. So that was really good lending, but it's not good lending, and we're back here. And the Austrians will tell you about it, and nobody talks about it. The debt overhang is just. It doesn't happen today. It's like Rafi says, do I know when it's going to happen? No. But you want to keep raising rates, which you have to do in order to try to wring your self-indulged inflation out of the system. And we saw it. Silicon Valley Bank. These are issues because as the Fed and Treasury were trying to do their best to protect the debt, the banks had to load up on something. Right? They were taking in all these funds. So what did they buy? They bought U.S. debt, and they extended out the duration, and because there was nothing on the short end. So, I mean, they did what they thought, well, and they bought into the Fed argument that there will be lower for longer. Well, when lower for longer didn't work, but we haven't even gotten to the debt issue yet. Yes, government debt, yes. And there is a phenomenal fear. Because again, and Richard, you and I have talked about this in other podcasts. Once the cost of financing the U.S. deficit on an annualized basis exceeds The defense budget,
Right.
we are in a very difficult political situation, and we're close. And then you look at around the rest of the world. You know, you look at the Europeans. Lagarde's in a tough situation because she inherited, but she's a politician and she knew exactly what she was walking into. Draghi's, 8 years, 7 years of absolutely insanity. And now she has to bear with it, but the Germans have grown tired. So as soon as they have an ECB meeting, whatever they do, then the hawks come out. When I say the hawks, I'm talking about the Dutch, the Germans, the Austrians, the traditional hard money forces within the ECB, a currency that they don't even control, and they start carping that we have to go higher. And they have to go higher. They can't do any, they're never gonna shrink that balance sheet. They can't.
And, yeah, go ahead.
Sorry, it's just, that's true. I mean, look, even conceptually, even if we had the most responsible hawks in charge of central banks, the structure of a central bank makes it impossible to be responsible it's logically impossible, right? Because you're talking about the debt overhang. There's so much debt, but debt is really just the other side of the balance sheet of the same money supply that we're talking about. I mean, it's the same stuff, because how do they bring money into existence? They buy debt. So it's the same thing. Now just to understand what the hell is going on here, why it's impossible to be responsible and moral or whatever, because the structure of the system makes it impossible. When a central bank buys 100 currency units of debt for, and then hands out money to whoever they're buying the debt from, their local government or whatever their federal government happens to be, and then more money is owed back to the central bank than they printed into existence to get that bond for any system. So meaning it is impossible to lower a balance sheet, because if you're bringing $100 into existence and being owed back 110, you're going to crash eventually. The only way you can lengthen the runway is by lowering interest rates and lengthening the principal maturity, right? You can keep lengthening the runway, but eventually it runs out. And the question is, what happens when it runs out? When it runs out, all of these gold substitutes and dollar substitutes and other substitutes for other substitute currencies, they're all going to zero. And the only thing that will be left is hard assets, principally gold as the most liquid trading asset, which is what makes it a money and why it is still money. So what I'm waiting and anticipating in this dry tinder is really the collapse of the entire global currency system in totality, except for gold and silver. And then we'll have to redenominate everything in terms of ounces and forget Bitcoin. Bitcoin's just another derivative. Bitcoin's just another crazy insanity. It might be worth a speculation, but I'm not a speculator. I'm a philosopher, so I don't touch it.
Interesting. And if we focus on the U.S. Central Bank, Federal Reserve, what are your thoughts, Rafi? Will they keep raising interest rates, or will they pause? Will they reverse? Under what circumstances? Your thoughts?
If nothing falls apart and there aren't riots at the Mariner Eccles building and people aren't picketing them, they'll keep raising rates until everything falls apart, and then they have to fly to Epstein Island to save their lives, and then they'll cut everything to zero and leave. That's what'll happen. I mean, they'll keep raising until they can't, and then when they can't, they'll fly off.
And your thoughts, Ira, on it?
Well, I don't know if it ends like that, but I do know that the picture is not pretty. And if we go to the MMT crowd, which for the life of me, when you read them, they talk about this, but their ultimate act is that, well, citizens are responsible enough, so of course they'll vote to raise taxes in order to stem. And I always found that absolutely, there's no chance in the world. I don't know what country they're looking at. We know one thing about the United States. If you talk about raising taxes, you don't get elected. You can talk about them right after an election, and you might be able to move right after election. But here it's now July of 23. We are ready. We're 17 months away from the next presidential election. And there's no chance in the world, because one thing we know about the American electorate, they're not very responsible, especially when it comes to fiscal they don't have a concept of monetary policy, but they do have a concept of fiscal policy. And in order to basically create the recession that MMT is based on, they expect voters to be responsible. And that's Warren Mosler's words, by the way. He talks about, I'm paraphrasing because if they want to challenge it, he doesn't say that, so I'll be paraphrasing, but that's what the outcome is, that, well, the electorate will be responsible and raise taxes. As soon as I read that, I go, that's not a possibility whatsoever. Listen, we can't deal with Social Security, as we've always called it, the third rail. I don't know where they're going to go, but yeah, I'm kind of surprised that we haven't seen demonstrations in front of the Eccles building. But watch, if unemployment, which this dual mandate is one of the greatest magic tricks ever, and yet they keep adhering to it. I don't know. I don't know where it goes. I don't know how it goes, but it's not going to be good, because the liabilities that have been built up are just enormous.
I mean, you're talking about MMT. These people are crazy, but they're not fundamentally different from any central banker, even the most hawkish central banker. Fundamentally, it's the same message. It's just a question of degree. Like, let's say you had like a right-wing central banker, I don't know, Alan Greenspan, who okay, believed in gold or whatever. He totally screwed everything up. But we would call him, what we had this like optimistic, what was her name? Judy something. What was it? That gold bug who was supposed gold bug?
Judy Shelton.
Judy Shelton. Yeah, everyone was like so excited. Oh my God, there's going to be like a gold bug on the Fed. She's going to have a tiny little place on the FOMC. I'm like, we just had a guy who was a gold bug head the Fed for like 15 years or 20 years even, right? It was until 2006 or he was like from 1985 to that, he screwed everything. He was horrible. And he was like a central gold bug. Like, so anyway, but MMT, basically the point is that you create monetary units and it makes people richer. But that's the basic tenet of every single central bank on the planet. That's what we do. We make more paper, and then everyone is better. I mean, okay, so the conservative people will be, look, well, it doesn't exactly work that way, but eventually, if you do it responsibly enough, then the paper makes people richer. But no, it doesn't. It doesn't. And the MMT people are just more liberal about it, but they're all the same people.
And any thoughts, Rafi, on like U.S. interest rate trends or yield curves? Do you look at spreads like 210 or 530 on the bond?
Yeah. I look at those. I don't, again, the whole funhouse mirror monetary universe is so warped today that we can't really make any historical comparisons with anything, because we've never done anything like this before on a global scale. I mean, we could maybe look at spreads in like, hyperinflationary France or Weimar Germany. That would be an interesting, research project to see what the yield curves were in these pre-hyperinflationary countries and what kind of signals were you seeing. I mean, I'd have to, look in I don't know, microfilm or libraries or something for that, but I don't even know where to start looking for that stuff. So yeah, I'm seeing extreme warping in all of these, and all of the yield curves, even the 30-year minus the 3-month. I mean, it's an all-time record inversion, and but what does this even mean? So yeah, it can't be this way for long. Just when is it going to reverse? We haven't been in this sort of a negative yield curve. I think we were in it for 8 months. I think the record is like 10 to 12. Does that mean we have 2 or 4 months left? Maybe we'll be stuck in a negative yield curve for, I don't know, a year or two. It could be anything, because like there's nothing to compare any of this to. That's the problem.
Interesting. And your thoughts, Ira, for the
and the curves. So
Yep.
I mean, the only time we can compare it really, and of course, when Powell started down the path, what did he talk about? Finding his inner Volcker. But again, when Volcker, and I was very active trading and analyzing during those years. So when Volcker inverted the curve dramatically, by the way, the 3-month to 10-year to 30-year went to a negative, I believe, at the height of it, 600 basis points, negative 600 basis points, because the only way you can wring inflation out of the system historically is with overnight money. And he was willing to pay the price, but the price he had to pay was not as great because, when you look at the debt levels, it was 1979, 1980, 1981, 1982. I grew up in a household, you didn't have credit cards. I think we had a credit card at we did, at the local department store, and you paid it off every month if you, and that was, so my mother didn't have to give me money if I wanted to buy clothes for school or something, and she would send me with the credit card dedicated to that store. Credit was not, as widely utilized, and the U.S. debt to GDP ratio was 39%. And a lot of local governments at the time were not, New York, of course, went through its difficult time. So you could be far more dramatic or in short term with moving rates because you were going to experiment with it, but you didn't have the issue of personal and public debt like we have now. Now we're at what? 120%? I mean, it ties your hands dramatically, as it does. And Rafi talking about this, the people who are carrying, and we know the consumer is right now, the end of the massive amounts of stimulus, fiscal stimulus that was issued, they've eaten through that. These people will tell me about the savings rates, which was 17 or 18% during the height of it, which was, for America, that's crazy time. We're down to 4.6% on the savings rate, but the installment debt levels are growing dramatically. So this is a difficult time. And if those think that, well, I'm going to keep raising rates because, I'm on this battle with inflation that we created, which of course they never say, it's this, that, and the other. But I think that if they were to account the pain, and they can't take that pain because we know that the Fed is a very political entity, by the way. Greenspan was a very responsible hard money advocate until he got into the job.
Yeah, and his head, yeah.
Yeah. Well, and in the 60s when he wrote, and when he was, and I used to subscribe back then to Townsend Greenspan and read their out, so pretty good sense of it. So I mean, this is a whole different place, but this is the compilation, as Rafi says, of a lot of bad policy for a long time. And I always, when it comes to Greenspan, I always cite the work of Bernard Connolly, and who says, with Greenspan, who he at one time had a lot of respect for, Greenspan's view on capitalism was you always hurt the one you love. And Greenspan, the politician, hurt the one because he stopped performing in a fashion to really have beneficial money policy for the sake of the political view.
Yeah. The irony, and Ira, I want to ask you a question.
Yep.
The irony of Greenspan's life is that he himself became the quintessential villain of an Ayn Rand novel. That's what he became. Like the guy who has potential, but he turns to the other side because he's just too far down the hole already. He's got to keep going. Forgot whatever professor it was of that university in Atlas Shrugged. I forgot his name, but anyway. So Ira, you were in charge of the CME for what years? Which years?
No, I wasn't in charge. I was on the board.
Okay, so whenever you were the highest up or whatever you were,
yeah.
What year was that?
Well, 97 to 03. Then I had to go, as I said, I had to go back to work because that was the transition years. And then for part of I think it was 2019, from from August 9 of 2019 to May of 2020.
Okay, so there's two schools of thought in the gold and silver community that I interact with. Maybe there's three, but there's two that I know of, right? One of them holds that the entire the CME holds down gold and silver prices, and with the big banks and spoofing and all this other stuff, and it's all a big scam. I'm not in that school of thought. I think that I'm more of the camp that there are two prices for gold. One is the industrial price, which is basically what it is now, and it's fine, because otherwise there would be like gold shortages for actual, industrial use, which we don't see any shortages. So if we don't see any industrial gold shortages, then the price must work, it must clear. Where the price of gold is not right is the monetary price, which would be the price that if everyone turns in their dollars today and doesn't want any more dollars and they want gold instead, what is that exchange rate? Okay. I think that's somewhere around $40,000-$50,000 an ounce. That would be the 100% backing rate.
Right.
So what I see the futures exchange for gold and silver, it's not necessarily that small scale corruption is happening on that exchange and people are lying about whatever. I think it's the very fact that gold and silver futures contracts even exist is the problem. Where do you think there's any fraud going on in the gold and futures future trading casino, or is it legitimate within its own rules? And who do you think is right here? Because I think I am, but I'm biased.
Well, this is my opinion, and I will state categorically that I still own a few exchange seats. So I believe in the exchange as a very reliable, capable, credible place to trade and hedge. Otherwise, I wouldn't be doing it. Now, I've heard these same stories for a long time. Now, here's one thing that I could promise you. If in fact that was the case, and I think that the trading, especially since the CME itself has absorbed basically all of its competitors except for the Intercontinental Exchange, but they never really competed directly on a lot of things. In fact, the Intercontinental Exchange tried to adapt currencies and failed miserably. They have the dollar index, but the dollar index to me it's something I watch, but I never trade it. But I think the credibility of the CME is great and has proven itself. Now, people who think otherwise, okay, think what you want. But if there was, now, I don't believe in the spoofing aspect. I think there were some large traders who would attempt that.
Even if there was spoofing, I don't think it would have much of an effect on the price. It seems like peanuts.
Right, because there's always somebody bigger. It's what I call the schoolyard effect. You may think you're the toughest one on the schoolyard, and all of a sudden somebody else shows up and you're not, and you get kicked around. There's always somebody bigger, and somebody bigger would always be aware that, hey, there's somebody playing here. We saw it with the Hunts in 1980. That was exactly what happened to the Hunts. The Hunts actually tried, and I was very privy to that, and trading. The Hunts tried to corner the silver market, right? And
didn't the CME shut down new longs in 1980? Isn't that illegitimate?
The CME didn't have silver in 1980, by the way. The Board of Trade.
Okay.
Now, did the Board of Trade and the COMEX, who were the silver traders, they raised margins, of course, but if they raised the margins, they did that with the regulatory approval of the government, because they do that now. But now margins are set, just to get rid of that, margins are set by an algorithm. So when volatility increases, the cost of margin increases. The exchange, as a self-regulatory organization, has the ability, with advice and consent from the CFTC, that if in fact there was an attempt to squeeze, and there was a real squeeze going on, they could do for liquidation only, or they can set at a price, I believe. It's been a while since I've looked at this, so I'm not, don't quote me verbatim, but there are rules in place to deal with that. I think you do see at times, and this is a function of exactly where we began this conversation. There is so much liquidity around the world, and you have sovereign wealth funds, the Saudis, the Chinese, the Russians. We can go the Norwegians who have active trading operations. So they have a stake in this game, and they have the ability to move markets like nothing we've ever seen. And the Chinese especially, and the Chinese are competing with the Shanghai Gold Exchange, which is priced in yuan. So there are a great many players that dwarf whatever the Hunts tried to do. And if there was really that shortage, because let's go that, because I've heard this and people will call me and go, oh, I hear there's no gold in the exchange warehouses. So they squeeze it at delivery times. But believe me, the big players would know if that was the case, and they would squeeze the exchange. And they go, okay, I'm taking delivery of 30,000 contracts, which is, at 100 ounces. So 30, so it'd be like I'm taking delivery of 3 million ounces of gold. Well, you got to come up with it.
That happened in 2020.
It happens. Yeah. And look at how many central banks are busy, but they haven't gotten to that extent. In fact, I look at some people. In fact, I just did a podcast with Adam Rosenzweig from Gehring and Rosenzweig, who do some really good work. And they always cite the position of the hedgers versus the speculators. Mm-hmm. It's, and I know people who will decry. I read a lot of the same things that evidently that you do, Rafi, and they're playing and they play. But if the central banks keep taking gold out of the, to put it on deposit at the gold banks, and we know this is going on in a big way, we will probably.
Wait, what does that mean? Can you explain that?
Yeah.
What are you talking about?
So the Chinese convert dollars into gold. They don't tell you, but the mainstream media, mainstream financial media, for the last 9-10 months, we've had people bring up that point, how much gold the central banks have bought, because the Global Gold Council will tell you, because they monitor that. They don't tell you on a day-to-day basis, but so why are the central banks like Russia? Well, we know why the Russians are buying gold. Why are the Chinese buying gold? I had a discussion this morning with somebody I have a lot of respect for, and we were talking about it. And because Zoltan Pozar did a recent interview with Bloomberg Television, which in a piece, he talks about central bank digital coins. Okay, not Bitcoin, but central bank digital coins. And even Lael Brainerd, when she was still on the Fed, gave a speech about central bank digital coin. And in there, I had to read it 3 times, Rafi, because she talked about the Fed central bank digital coin having some gold backing. I had to read it 3 times. I mean, because we're talking about somebody who is absolutely, all the way up to her eyeballs in the concept of Keynes and the Barber's relic. And then,
what the hell is Lael Brainerd saying anything about gold for? I don't.
Well, yeah, I had to really think about it. The Chinese. I understand, because if the Chinese want credibility for a currency, I maintain that they could establish a central bank digital coin, and if it was backed 20% by silver, gold, platinum, and maybe some other things, it would gain instant credibility because nothing else is backed by anything. Now you could, in my discussion this morning, I said, well, who would trust the Chinese to honor that? I said, they don't have to. They can create a depository that they don't control except to what's in there of their money in Singapore. If you don't want Singapore, Switzerland. And it's really interesting to see that Singapore and Switzerland are both places that have walked very gingerly lately as to how they go about and deal with the Chinese. So there is a lot of things that could take place here, more uncertainty, but there's no question that the central banks have been hoarding gold. Now, my response is the central banks are not very good traders over time. Because if we go back to, when was it? 1999, 2000, the Bank of England sold off its gold and I can tell you the price, it was probably around 280, 290 in dollar terms. And
Yeah.
what was really amazing is that one of the best probably the best technician, meaning the chartist that I know, was at that time telling me the gold was breaking out against the euro. The euro had just been launched, and he said, you got to buy gold and sell euros. And we looked at a lot of analysis, and in fact, I did. And I actually called a few banks. I said, I would like to borrow 500 million so I could buy a lot of gold from the Bank of England. And they go, we don't need you to do that. So why would I lend you the money? Because if I wanted to do that, I've got other clients with a far better credit situation. But it was interesting. So it's not like I always pay attention to what the banks do. I'm more concerned about the IMF, because the IMF is a Keynesian-based institution. And yet, for the most part, they hold on to their gold hoard, which they'll tell you is owned by all the members, whoever is contributing to that. But why don't they sell that gold off? Why is not the bastion of neo-Keynesian and Keynesian economics, why do they hold gold?
Yeah.
Why do they hold gold? I've always maintained that if
The IMF, the International Mother Bleepers. But yeah.
Well, Rafi, so why don't they take that gold hoard, which I think is worth about 220 billion, 200 at current prices, maybe a little bit more. Why don't they float IMF bonds with a 10% gold backing? People would rush for that.
Yeah.
I mean, in today's world, and you could borrow at a cheaper rate if you had to go. What are they holding that gold? Like, what are they? Moses leaving Egypt, that they're holding that gold? Why does the IMF continue to hold gold?
Mm-hmm.
Believe in it.
Because it's money.
It is money. Bingo. Bingo. Bingo.
Can I ask you one more question?
Sure.
I haven't been able to figure this out, no matter how much I read about it. And it's all those conspiratorial theories and unclear progressions of what happened and how. But what was that flood of gold into the COMEX in 2020? What caused it? What the hell was going on? You see, like the level of gold in 2019, early 2020 was like very, very low, the eligible and the registered. And then all of a sudden in 2020, it's just like boom, like up to like 14 million ounces, like in a few weeks. What the hell happened?
You know what? I don't know, but because I watched the same thing you did. What was going on? But I think the problems at the LME were so great that people were very concerned about what they had on deposit at the London Metals Exchange. And I think
those are base metals, though.
Huh?
Those are base metals, though, not precious metals.
No, they have
right?
precious metals too.
Oh, really? Okay.
So I think that people moved out of London and wanted a more secure, and it was really a vote of confidence in the CME. I'm pretty sure that was the timeline. So it was like, no, because there was really people, look at what went on there, and they said, well, what is going on here? This is, and the LME is still struggling. Well, their reputation was so badly damaged.
They have a big lawsuit going on now.
Yeah, it's still going on. There's still some, but I'll tell you when we used to see things similar to that. Mark Rich, who I have followed and I watch him through, well, he's long since gone, but Mark Rich and company, they used to move gold and silver and copper back and forth between the COMEX and London. And by playing with the receipts, the warehouse receipts, they could get a lot of volatility in those markets because, the London Exchange would go, the London bullion dealer, there's a huge drawdown. Well, who was the drawdown? It was just Mark Rich and maybe a couple other huge firms moving the receipts back and forth. And so we would get some great volatility. I'm going back to the late 80s and 90s. So you would see that games. Today, it's a tougher world to do that in. First of all, the flow of information is so much better. On the other hand, the central banks are far more active. When I talk about that, I'm talking about the Bank of India, the People's Bank of China, certainly the Russian central bank. There are a lot. And then, of course, we've had some of the smaller ones in Latin American banks are also seen as boosting their gold positions.
I'm of the camp actually that central bank gold buying is not as significant as gold bugs might want to intuit or impute, whatever the word is.
Yes.
You know, I just look at Turkey, right? And Turkey is often lately among the main central banks that have the biggest gold purchases per month or whatever it is. And I've seen their gold hold. It's gone up and down, and recently it's gone up. But has it protected? Has their gold purchases or selling, has it protected their currency at all? Not at all. Nothing. No. It's I just if a central bank is going to buy gold as a tool to mess around with its currency exchange, it's not going to protect anything. The only way that gold can protect a currency is that if a central bank buys it and says, look, we're not selling this stuff and we will exchange it to you for a currency at a fixed rate, and then we're getting out of the money printing business, then it could do it. But this central bank buying gold, I don't think it means anything anymore, because they're just going to sell it when their currencies collapse, and then hopefully because they don't see gold as money, they see it as a way to mess around with their artificial exchange rates.
Well, except I think that we've seen certain banks buying it because they're a little bit nervous, and as your reserves grow, and I'm not talking about the Turks, that's Erdogan and company have been I look at 26.1 lira to the dollar. You don't have to, it doesn't take a genius to figure that out, that they've been irresponsible to the nth degree. And when you want to see irresponsibility, they're on par with the Argentinians, of course. But I think that banks, because they build up so much reserves and they look around just like any astute investor and go, well, I don't want all my money in dollars, especially after I just saw the sanctioning, right? Why would I want to hold? I want to diversify away from that. And it's kind of hard. It's not kind of hard. It's very difficult to respect. And it's where we started out here, the credibility. And it is, we're just talking about credibility. And to me, gold is not a hedge against inflation. Gold, as I believe, since I've learned in the 80s and early 90s, gold is about central bank credibility in a fiat currency world, whatever we want to call it. And that's what it's a hedge. If you're buying gold for inflation purposes, by the time you're buying it, it's too late. And you're paying huge with depreciated assets. But if you challenge the credibility of the central bank, or all central banks, and I think that's going on in Japan, by the way, that even Japanese investors, holders of assets are going, well, yeah, I'm not so sure. And then the Chinese are suffering of it too. And of course, India has a long history of people putting assets, a bigger share of their proportion of assets into gold. And so how much? I don't know. But if I'm China and I've got six trillion, because now all of a sudden they're writing that there's an extra 3 trillion of dollar assets being held by so if I hold 600 billion, 10% in gold prices hold up, because really from a trading perspective, and I keep making this point, with the yield curve inverted, let's use the U.S. It made all-time highs since, unless we go back to 1980, 81. But last week, it had recouped all its movement from when Silicon Bank and Credit Suisse and Signature Bank, and of course, First Republic basically became insolvent. We had a dramatic move to uninvert the curve. We went to about negative 28 from 109. We actually made a new high last week on the 210, a new low, I should say, because we were inverted all the way to 110. So now gold has no business at this level based on historical analysis, because when a curve inverts, it's not positive for metals. Precious metals suffer an inverted curve because the bank is deemed to regain some of its credibility because it's becoming an inflation. It's willing to endure a recession and a slowdown of the economy, and then all of a sudden, paper assets start to attain greater respect. I mean, that's what it shows. But this time, the gold's not giving way. I mean, we're still at 1930, 1920. That's awfully high. And I'm talking about the global yield curves because they're all inverted. Why is gold not getting pummeled here by the speculators?
Why? Because I think because we are on the verge of some kind of next level banking crisis. They stopped it for a while, but the problems are all still there, except they're on the Fed's balance sheet instead of the individual bank's balance sheet. They just said, "Hey, well, let me just take your debts again and just sweep it under the rug." It's all still there, but I think everybody knows that at the next crisis that they can't stop, they're going right back to zero, and that'll be the end of the dollar. I don't think they're willing to admit that in their heads, but that's what I believe. I think we're on the edge of it. They never cut rates slowly. They always cut it out one fell swoop, especially since 2008. That's what they're going to do again. And if can I share my screen? Am I able to do that?
Should be, yeah.
So there's one chart here, which I can show you graphically why
Yep.
why they're losing.
Can
This
see.
one, right? This is the Federal Reserve remittances to the Treasury, or basically how much money they're making or losing each week. And this is the cumulative position over here. So you can see here the line just goes straight down, right? Our boxes are in the way. Let me try to remove them. Yeah. So the cumulative loss here is 74.269 billion. It's going to get worse. This is the Fed losing money. This is the dollar. This is the graph of the dollar dying. Okay, this is it. And it's just going to keep going down and down and down because all the bonds that they have purchased are now less value, and they keep paying more interest in the reverse repos and the interest on balances that they pay. This is the Fed going bankrupt. That's why that's why the gold is moving up.
But they never paid interest on excess reserves until 2008.
Because they never printed so much excess reserves. Now they have to pay a bunch of money for them to keep it into the system, or else explode the money supply.
Right.
Yeah.
So up until 2008, they never paid interest on excess reserves. But and that's why all these people would scream and yell. Like Rick Santelli, when he would talk about what are they doing in 2008, and then where's your inflation? Well, the money just went on deposit at the Fed. It never experienced any velocity in the system. And that's why they moved to pay interest, because the Fed knew if they didn't, that you would have had this inflation in 2009, 2010. But by parking and earning something, and Steve Leisman would be screaming at Santelli, "Where's your inflation?" Well, they failed to look at that. And now that because it's come at them and they've had to raise rates quicker and faster to try it's all about central bank credibility. That's their main concern, because they were so irresponsible that now they're trying to, and yet they're reaching a point, and that's in Rafi's chart from the St. Louis Fed that's what it's showing. And for those, Rafi, I know I'm going to tell you something. I was at Jerome Powell was just a governor in 2016. So I happened to be at a symposium the Monday after the Brexit vote. where Powell was speaking in Chicago. So I went and I was able to ask a question, and I asked him two questions. One was, did he agree with the Basel Accord that sovereign debt should carry a zero risk weighting? And he dodged that by telling me that, or telling the audience, I just asked a question, that that's what Basel decided, and I have no further opinion upon that, just the way it is. And then I asked him the question, well, who guarantees the ECB with its massive balance sheet that it was already starting to build? And his answer was very short and to the point. They have a printing press. So that is the dominant theme of all these central bankers. When I bring this up to people, I go, aren't you worried about the losses that the Fed is incurring? And the average person says, well, they have a printing press. You don't have to worry about it. They can print money. Well, to
Great.
me, it's a very flip answer that does not give me comfort. But the worst part about it, if we go back to 2019, 20, 21, and Congress, especially once COVID, the intervention with COVID started, and the Fed was earning interest, right? They would purchase the treasury debt and receive the interest payments, 50 basis points, 75 basis points, and they were remitting the interest to the Congress. In fact, it was a budgetary item for Congress. I remember there was an $81 billion check that one of the congressmen was holding up because it went into the highway fund. Wow, look at what the Fed's doing. I said, understand what you're saying. Then I'm going to quit working because we've now invented a perpetual money machine. Just keep issuing debt. Why does anybody have to work? And people would say, oh, huh? I will think about it. I said, what am I missing here? Why am I working? The government can just do this all day long. At least when they did it, we're smart enough to buy real assets. You know, they bought Apple stock, they bought Microsoft, they own assets.
Yeah, well, people got to go back to the second chapter of Genesis. You know, the man ate from the tree of knowledge. Now he has time preference because he's no longer immortal. We are all going to die. Our time here is limited, and we are going to sweat, and we're going to work because we're not in the Garden of Eden anymore. So stop fantasizing, okay?
I thought you were going to bring up Shemitah and Yovel.
No, let's just keep it simple. Let's keep it simple. You know, we have to work. We have to work for a living. That has not changed, and it's not going to.
I was waiting for you to blow the silver trumpet, and I was going to get a debt.
Yeah.
No,
Well, yeah,
this is a great discussion.
great discussion, yeah.
Very
With
so.
great insight and points, perspective. Just how can our listeners and viewers learn more about your work, Rafi, like on the Endgame Investor?
Mm-hmm. The Endgame Investor is a service through Seeking Alpha. You can just type in the Endgame Investor to Google or any search engine. You'll find me at the first link. It's a 3 to 4 times a week report, mostly on the precious metals markets, but mostly on monetary issues generally, like central banks, currencies, and the interplay with gold and silver. And I try to just keep the eye on the general ball of, like, you can't go wrong if you just stay balanced and, you know, buy a certain amount of gold and silver a month and keep liquid, and don't get too greedy and don't get too crazy, right? That's the basic approach, right? And then I work around that. You can also find me on Patreon, where I give a once a week biblical commentary on this stuff. Whatever is happening in the weekly portion, I usually comment on that, sometimes other things, or if somebody asks me a question. There's a lot of gold and silver and economics in the Bible. It's a lot more than you might think was actually there, but it's a lot. And you can find my YouTube channel, Rafi Farber. I try to be funny. I try to be cynical and keep people sane, keep myself sane, really, by talking about these things, because otherwise I would lose it.
Great. and Ira from your side.
I write still doing some blogs on Notes from Underground, but doing these podcasts. And again, here we get to discuss really deep issues and try to make it. It's not like we're offering an investment to go out and buy this, and I think when we do this, but we have the discussions, again, it makes people think. And you can't just absorb what the authorities are throwing at you, because it's not, you have to think about things. And if you're trying, and what we're really talking about is the way to protect your wealth. That's the important thing. And to not just sit there and wait and to be able to be proactive rather than always be acted upon, and to think a little bit. You don't have to agree with one word that we discussed here today. But if you don't agree with it, know why you don't, and then you're way ahead of the game anyway. So I applaud Rafi because educating people and helping them understand. And things are complex. Things can be simple if you bother to delve deep enough and say, well, I see the way this works. So I think these serve a really good function out there if you avail yourself of them. I know it's you might have to walk away from your television for an hour and actually spend some time thinking about things. But okay.
Yep, great. Thank you so much, Rafi and Ira. Thank you.
Rafi, a pleasure. Thank you for the time.
Thanks for having me.
Yep, thanks.
Thanks.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.